Hi learners, Professor Joe here. Today we are going to discuss about financial statements. Now we are not going to go into the details of financial statement. We are just trying to understand. So you can say that it's like finance for non-finance, understanding what are the financial statements. So let us have a look at all the financial statements that a business have to manage. Step 1, what is a financial statement? So, a financial statement is basically a written record or a documented record of all the financial transactions that is happening in a company. Now, all these financial transactions has to be recorded as per GAAP. Now, what is GAAP? GAAP is generally accepted accounting principles. Why is GAAP important? Is because see, if you are maintaining your account in one particular format and it is your own format, and anybody outside the business does not understand, then it is very, very difficult for the others to find out whether your business is profitable or not. Now, all the stakeholders are interested to know whether the business is running profitably or not. Now, when we say stakeholders does not only mean the people who are investing money in a business. Stakeholders are also the employees. They must know whether the company is doing well or not. The suppliers of the company, they also must know because suppliers give credit. The government, they should know whether the business is doing well or not. Of course, even the people who give loans to the companies like banks and financial institutions, they also must know whether the company is doing well or not to give a loan. Not only to the company, but also to the employees. So when an employee goes for a loan, a personal loan or a home loan, they ask, which company are you working for? Why is that? So that the bank knows that the company in which the person is working is doing well. So GAAP is very, very important in maintaining the records, especially of all the financial transactions of a company. Now, all these financial transactions are recorded in multiple statements. But the most important statements is the income statement, the balance sheet, and the cash flow statement. So today we will try to see what are the basics in these three types of statements. So the first type of statement we are going to discuss today is income statement. Income statement is also called as profit and loss statement. Now, income statement or the profit and loss statement records all the income and expenses in a company for the whole year. So whenever there is expenses, it is recorded in the debit side, which is the left side. That's what we see. And all the income is recorded on the right side, which is the credit side of the income statement. Now, income basically is income from sales, but there are other type of incomes also in an organization. The first type of income in an organization is income from sales, or you call it income from its operations, which is the most important form of income. The second type of income is income from financing activities. That is basically if the company is raising funds. It can be through IPO or through any other sources. And the third type of income is income from investing activities. Okay, so wherever the company has invested its excess money, it could be in projects, it could be in shares, or it could be in the bank. So income coming out of that activity. So three types of income is there for a company. Whereas expenses is all the different kind of expenses. Expenses are like rental expense, salaries, depreciation, admin expenses, marketing expenses. All these expenses are expenses of a company. So throughout the year, the income and the expenses are recorded in the income statement or the P&L statement. And at the end of the year, they will check the balance and they will come to know whether there is a net profit or a net loss after you balance the income statement. Oh, this is how an income statement looks. Of course, the income statement is pretty long, but this is just for an understanding purpose. The left side is the debit side, the right side is the credit side. The left side, all the expenses are given, and the right side, all the income is given. So first type of statement is income statement. The second type of statement, that is balance sheet. Now the balance sheet is a very simple statement. A lot of people get confused, but balance sheet is a very simple statement. The liability side of the balance sheet shows how the company has raised money, whether it is through equity, whether it is through their reserves and surplus, or whether it is through long-term debt, short-term debt, or they are using other people's money, that are the creditors. And the asset side of the balance sheet is the application of the funds. Very simple. So when you talk about application, all the money that has come, either they have invested in land, building, machinery, or they have finished goods, or they have the money is lying in the bank, that is cash at bank, or the money is lying in the office, which is cash at hand, or they have money to get from people, that is basically debtors. So balance sheet is a statement which is prepared in the end of the year, and it is a snapshot of whatever has happened throughout the year. Now it is called a balance sheet. Why is it called a balance sheet? Because the liability side and the asset side has to balance. As I said, one side is how the money has been raised, and the other side how the money has been used. So there cannot be any extra money here and there. So if they have raised, say, $1,000 and they have spent $1,000, or they might have spent $800, then $200 will be in their bank account. So again, the balance will be $1,000. So very simple. Balance sheet is a snapshot of the assets and liabilities for one particular day. Normally that day is the year end day. This is how the balance sheet looks like. The liabilities on one side and the assets on one side. Liability. Now, a lot of people also get confused. Why is equity called liability, or reserves and surplus called liability? Because in accounts, there is one term, that is identity. A company is a separate identity from its owners. So when money is invested in form of equity, it is invested by the owners or the person who is taking the equity in the company. That's why equity is a liability. And reserves and surplus is also a liability, because reserves and surplus actually belongs to the equity holders. The company is holding it back for future projects. So that is the reason even reserves and surplus is seen on the liability side. The rest is long-term debt, short-term debts and creditors. And on the asset side, it's the application of fund. You can see land and building, plant and machinery, furniture and fixture, and so on. So very simple. Okay, so don't get confused. It's a very simple statement. The third type of financial statement is a cash flow statement. Now, cash is the king. There are companies with very good business models, but they fail because they were not able to manage their cash flow. Cash flow plays a very important role. So, how you are managing your cash, that means what you have in your hand, how are you spending it, and whatever is coming, how are you retaining it, is basically cash flow. So cash flow will have an opening balance of cash, and then all the inflow of cash, and then all the outflow of cash. Sometimes even a business which does not have a very good business model, an average business model, still is successful in business. Why? Because they know how to manage their cash flow well. Any business who cannot manage their cash flow well will go into losses. So the most important thing in a business, of course, is profit, but also managing the cash flow, the day-to-day cash expenses and the day-to-day cash incomes has to be managed very well. And that is recorded in the cash flow statement. This is how a cash flow statement looks like. Okay, so basically it starts with an opening balance, and then all the income, then all the expense, and then what is left behind. So in summary, whenever you are looking at a business, you have to look at these three financial statements. That is the income statement to check whether the company is making profit, especially profit from its income from operations, not from financing activities and not from investing activities. If a company is making profits from its operation, it's a good company, then depend on the percentage. The next is the balance sheet. How much money has been raised, how much equity is there, how much debt is there, how much they are using in fixed assets and in current assets. And the last statement is the cash flow statement, how a company is managing their cash flows, how much they are getting and how much they are spending, how they are managing it. So if you are able to understand these three statements, which is not very complex, it is simple. All you need to do is understand the income and the expenses. So if you have a look at this and if you understand these three statements, you will have a fair idea whether the business is doing well or not. So the income statement is showing the financial performance of the company. The balance sheet is showing the financial health of the company, and the cash flow statement is showing the cash management of the company. Three important aspects of a business. So that's all in this session. I hope you'll have understood something in finance. All I can say is keep learning, keep growing, keep getting better each day. If you like the content, please like it, share, and subscribe. Thank you. Namaskar.